Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of an Investment Friday on the Expansive CEO podcast. It is Thursday, October 26th. Timestamp is 5:06 p.m. I am here with who other than Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. What's up, man?
Good afternoon, Hannah.
What's going on this week? How are you? First, how are you doing?
Doing well. We had a little bit of some inclement weather, so that was good. Always gets you appreciative of sunny times in Arizona, so that's always good. But fortunately, the bond market has definitely I don't know, fortunately or unfortunately, depending on what side of this trade you're on, but bond yields have been very volatile. They've gone up or down 10 to 15 basis points, which is 0.15 of 1% on a daily basis, which is incredibly volatile for the bond market.
Mm-hmm.
And now we're sitting knocking on the door of basically a correction, which is 10% in the broader market indices of a pullback from their highs in late July. So the S&P 500 right now, as it sits, is off about 9.9%. And intraday, it did crack that 10%, but it did not close there. So it's not, people don't count it as heavily. So again, we've talked a lot about these top 8 stocks, these 8 mega cap technology related or tech companies that have been driving the market basically on their own for this year, for 2023. And we started to get some good earnings, and yet they're falling quite a bit in price. Why? When you're priced for perfection, you have to deliver perfect earnings and earnings growth. Well, if you don't, then your price takes a hit. And so, we've had Amazon, we've had Meta, we've had Tesla, all of those come in with less than perfect earnings reports, and those have sold off in kind of a big way, and that's what's pulling down the rest of the market.
All right, interesting. Yeah, I was wondering what was happening there, right? So that totally makes sense that when those stocks are essentially overbought, right? We've been talking about price to earnings ratios, PE ratios, that the PE ratios on those stocks are quite high right now, meaning they're, somewhat overvalued based on their actual economic activity. Like you're saying, if they're not, if the consumers or the investors aren't seeing, like they're definitely hitting these markers that we thought they would hit in order to be worth as much money as we think they're worth right now, that's the pullback.
Exactly. And it's one of these things that I don't want everybody to think that I think these are bad companies. They're not. They're fantastic. In fact, they're arguably the best companies that have ever existed. But the stock price can get divorced a little bit from their underlying fundamentals and their growth pattern. And so while the underlying companies are really, really good, sometimes those prices can get bid up too much, too fast for their growth prospects.
So Brad, we talked about this several months ago. And we've revisited it a couple of times over the last several months as well, how, you had been talking about, again, these, top 8 stocks. It's been, 7 to 8 this whole year, right? And that there could be the possibility that those would pull back because the rest of, if we talk about the S&P 500, the largest 500 companies in the United States, right? So the other 492, 493 had not been keeping up with that same growth rate at all, right? They were up like what, 1 to 2% when those top 8 were up 17 to 18%, something like that.
Correct. Yep, that's about
Um,
right.
so you had said, I mean, we could go back, I could probably find the clip even, that it's not necessarily that those top 8 have to like fall hard in order to come back to equilibrium with the other 492, but that we could see them come down while we wait for the other 492 to catch up. Is that what we're seeing now?
That is what we're seeing now. Yeah, I mean, earlier in the year, they definitely became overbought. And it becomes a problem. It's the law of large numbers, if you will. When you're a $1 trillion company, to grow 10%, okay, you're adding a large company for that growth. Like, so you're adding a whole nother multinational to your company's base for that growth. Whereas when you're a $10 billion company, to grow another billion, you're adding a small cap, arguably somewhere in the mid cap range, a small company. So it's not as hard to do. But when you're talking a $1 trillion company, that large numbers, it just, the probability of it continuing to grow is just not very high. It's one of the reasons why in all investing and all business schools, they go over the S curve, which is your function where, a company starts out small, doesn't really grow all that fast until it gets some adoption for its product or service. Then it accelerates up this very steep growth curve. And at the top of that curve, it starts to level out as the market value gets to be much higher, as the revenues start to stabilize. You just can't continue to grow exponentially forever. You just can't. It's just, it doesn't happen. So that S curve, which a lot of people will have seen in their lifetime, is very, very indicative of the life cycle of a company. And those top 8 companies are the biggest companies in the world. They're the biggest companies in the world. So when they get bought up, they can get priced out of where everybody owns them. Everybody owns them. Who is the marginal buyer for Apple now? I don't know one person that doesn't own Apple already.
Mm-hmm.
Right. So when everybody already owns a stock, even though it's a great company, who is the marginal buyer that is going to propel that stock up? I mean, you're going down to organic growth. It's going to all be related to their organic earnings growth, which, as I said, unless they buy in a bunch of shares and grow those earnings, probably is going to be a tough call. Not to say it can't happen, because it can, but it's just a lower probability event as opposed to some others.
So you mentioned the bond market instead, right? And if you're on the wrong side of the trade. So I think we talked about this a little bit last week as well. When bond yields go up, which they've been doing, the prices of current bonds that are currently held, those go down. So if you have, if you're looking at your own portfolio and you have like bonds packaged up in a mutual fund or bonds packaged into an ETF, a lot of times that investment that you have is probably going to be down this week as the
Right.
interest rates and the yields continue to rise. A lot of those bond mutual funds and ETFs are going to be depressed, right? The prices are going to be falling. So what's the upside? What's the plan, Brad? If that's
It's a
what
great
people are
question.
experiencing. Yeah.
Yeah, I mean, what we've seen now is short-term yields, which, as interest rates have gone up, those short-term yields have really gone up a lot over the past 18 to 20 months. Okay.
And
Since March
there,
of
yeah, just
22.
to say, like, short-term yields also show up in that's where we see, like, the high yield savings accounts and things like that, right? Like, when the short-term yields are high, that does tend to translate into things that, like, consumers actually
Yeah.
understand and can
So
go, like CDs from a
yep,
bank.
CDs, money market funds, high yield savings accounts, unfortunately, credit cards, home equity lines of credit, any of those floating rate um, liabilities that we as households may have, those also go up. Okay.
Mm,
Um, Now, when long-term yields start to come up, what that does is it constrains a lot of other types of financing. So mortgage rates go up. Um, Business loans, their expense goes up, their cost of funds goes up. Real estate, that those costs of funds start to go up. And so one of the things that people have been confused by is, why is the US real GDP growth so strong relative to the interest rate increases? Why has it not slowed down? And part of the reason is because we've had an inverted yield curve where our long-term yields have remained, up until the last couple of months, pretty low. They haven't really moved a lot compared to the short term rates. But now it's almost the opposite. Now we have long-term yields starting to adjust upwards, and we have short-term yields remaining the same or coming down a little bit. And so that steepening of the yield curve as those long-term yields come up will start to bite into economic activity from the real estate, the commercial, the industrial, and the home buyers. Um, Home buyers are also in a bit of a different pickle, because a lot of new homes, the builders are actually buying down the mortgage rates, which is why you'll see really good new home sales, but existing home sales are almost non-existent.
mm, interesting. Yeah, I've got, um, friends and connections in real estate, as a lot of people do. We've been having conversations around, what's going on in the real estate markets here in Cincinnati, out in Arizona, all across the country, basically, um, and what's happening there between new build and existing home sales and all of that. And that's been really interesting to follow as well. Along with more, I mean, mortgages are just they are much more expensive when your rate is 6 or 7%, for the same price house.
Yeah, and not only that, it's probably 7 to 8%. Um, those rates have gone up to, those 30-year mortgage rates have gone up to around 8%. So, if you're looking to buy, you know, you can get a pretty decent 5 or 6% rate from a home builder that's building a new home. They're buying down that rate for you. Um, that's a good option too, but they're also picking it up in the price. So it's an interesting dynamic right now, where I think builders can play with a few different levers for profitability. Um, and that's where new home buyers are getting the traction. That's where they're going,
Mm.
as opposed to existing homes, where you have to qualify for a mortgage. The mortgage is going to be 8% unless you decide to really allocate a lot of money to buying down that rate. So again, it's interesting for that perspective, but the higher yields generally are going to bite on economic growth here towards the end of the year, early 2024.
All right. Well, we will pay attention to that. And it's not a perfect segue, but I wanted to go to a question that we received from Bob, our favorite phantom third person here in our in the podcast,
Well, he
because
always has good comments
he
or good
always has
questions. So
great questions. And this week, when we were talking, he mentioned that he heard Janet Yellen on the radio. And Janet Yellen is the Secretary of the Treasury.
Mhm.
And so she holds some pretty big sway when it comes to talking about what's happening in the economy. She said, in talking to Sky News, that the United States can certainly afford to support wars on two fronts, as the conflict between Israel and Hamas threatens stability in the Middle East, and the U.S. continues to back Ukraine's fight against Russia. And so Bob's question first was how on earth would we be certainly able to fund two wars? And, like where is that coming from, where that would be possible, from an economic standpoint? And then the follow-on question of that, of what does that do to the economy and what should we be looking out for? So I thought it was a really prescient question, right? And something that a lot of people probably are like, if Bob's asking it, there are probably a lot of other people who are like, yeah, what do you mean we could fund two wars? And what does that look like for the economy? So tell me, what do you think? Where does that
Yeah,
come
it's good. It's a great question. I also heard that comment a little while ago. She mentioned it, and generally, what happens is, first of all, the U.S. plans for a 2 to 3 war theater. Okay, theaters of war. Okay, they in the Department of Defense long term planning. That is one of their objectives, is to be able to maintain two separate theaters of war at the same time and be able to fund it, supply it, and fight it.
just baseline at any given time? Like
Baseline at any
we
given
could
time.
just go start two wars anytime and
We probably wouldn't start them, but yes,
join.
respond to possibly aggressive action. Okay. And so what she's saying is not out of character or out of context with what the plans are in anyways. Now, economically speaking, wars generate economic activity. Okay. They are outside of the disastrous human cost, which I know I'm gonna step on my foot and minimize it a little bit, because and I'm not trying to, it's just, again, we're talking about the economics of it and the financial market aspects. So, but the disastrous humanitarian cost is something that is important to consider. But if you look at it from an economic standpoint, what happens is the government, and whichever government this is, they start to finance that war effort through deficit spending. So they get out the checkbook. Secretary Yellen would just start writing checks and start issuing bonds to fund those additional expenditures. So the national debt would increase. In fact, that's typically what happens as you go through large conflicts, is our debt grows significantly during those times. And then after those periods, when those conflicts are resolved, then it starts, the growth in that debt starts to drop off. Now, economic theory says that once you've reestablished your peacetime economy, you should start to pay down some of those debts so that you have a little bit of room on your credit card, if you will, just in case you need to start spending again for, an economic downturn, right? Fiscal stimulus. That's part of that fiscal deficit that is financed by our national debt. So during war, that you're going to run up the credit card, if you will, a little bit, by buying new weapons, training the soldiers and sailors and air people, by buying airplanes and weapons and ammunition for those tools. So you're going to spend a little bit more, but the thought is, and the theory is that once that war has ended and you've transitioned back to a peacetime economy, you should be able to pare down that debt so that the next time you have a recession or another conflict comes up, you have the capacity to borrow so that you can again finance some of those extra expenditures.
But when we think back to the last few times when we've printed a lot of money, right? So thinking about COVID, maybe even thinking back to previous conflicts and wars that we've been in when interest rates were very, very low, near 0%, the argument was, yeah, we could borrow as much as the government, not we the American people, but the government could borrow at 0.1% interest as much as it wanted to because the debt service on that would be very easy to manage.
Correct.
But now we've got higher interest rates, right?
Yep.
So how does that equation then change? Because yeah, afterwards, if we've, been through multiple fronts of conflict and interest rates are instead of at 0.1% or 0.25%, they're at 4, 5, 6%. What does that do? How do we handle that?
Yeah, so there's a couple of different the thought processes there is one is yes, the US government has spent an enormous amount of money since 2001, whether it be on conflicts, whether it was through decreasing tax rates, whether it was through pandemic relief, right? All of those have led to an explosive amount of national debt. Okay. Now, with the rates coming up, all that leverage, higher rates means a lot of our revenue is going to be used and that interest, just covering that interest. But I also want you to think about it on the flip side. Who owns those bonds? Now, there are some central banks that own foreign central banks that own those bonds. Okay. And there's a lot of them. Oh, there are some central banks that own a lot of those. Okay. So China, Japan, we pay a lot of interest to them right now. Okay. But a lot of pension funds, insurance companies, banks, individual people own the Social Security Trust Fund. They own treasuries. So, as an individual, if I owned a bunch of treasuries, I would collect now a much higher interest rate, but I'm also taxed on that. So it will be interesting to me, and I'm looking at the federal revenue, tax revenue, as to see whether it begins to climb due to higher rates, because it should to a certain extent, unless economic activity trails off to such an extent that we actually lower our tax base. I don't see that happening. I do see, again, we just had the third quarter, 4.9% GDP growth. Fantastic for the third quarter, higher than anybody expected. But, we are slowing down. We probably are going to continue to slow down, possibly go into a shallow recession here in 24, early 24. So it'll be interesting to see how those tax revenues from 2023 come in and how that, if it grows commensurate with that. Probably not. But again, I think it's important to recognize there's two sides of that coin, not just the federal government paying, but who also gets paid that interest, to understand that there's a lot of taxes that are paid on those bonds. Now, can we afford? Yes, we can. That's the short answer. The United States can afford to do that, but for how long and how big of a conflict? So can we afford a world war? We would have to, but no, it's probably not the best financial decision. It's probably not an easy financeable thing. Like, it would push yields on treasuries up significantly because now you're issuing a lot more debt and you have to incur, back in World War II, there was war bonds. They would literally come around your neighborhood and sell you war bonds to help finance the war. Well, we're not at that point today. We still have a lot of demand for US Treasury bonds. It's the world standard when it comes to safety. But as we get more debt out there, it becomes more of a possible credit risk from other people's perspective, even though it's still considered the safest investment in terms of the bonds.
So so we talked a lot about bonds. With that, if we were, so that's what we would expect to see, what we have seen before, right? In times of conflict in the bond markets and how we fund wars or conflicts. What happens to the equity markets?
It's a great question. Generally, they sell off pretty fast when a war starts. And why is that? Like, it doesn't change anything except for now there's an event going on. Well, the reason why equities sell off, because equities are very long duration assets. We own them for a long time. They're businesses, they involve people, they involve products and services. They're a long-term investment. And so any amount of uncertainty in the economy, in the market, in the geopolitical world, equities will sell off almost immediately. Then investors start to assess, okay, who's going to actually do well in this environment and who's going to get hurt. Generally, manufacturers do very well in a wartime economy. Okay. Particularly defense manufacturers, so aerospace, you get a lot of the defense contractors. So there's a lot of the companies that would do quite well if we went to war. Now, if it's a local conflict that we're helping out, yeah, it'll generate some economic growth, but it's probably not going to be on the margin very, very impactful. So yeah, so it would, certain companies would do quite well, other companies would not do very well. My guess is luxury goods, luxury good companies wouldn't do all that great. But yet other items like, again, airplanes, shipbuilding, ammunition, gun manufacturers, they do quite well, particularly the ones that have ties to the Department of Defense.
And so when we're looking at this is what I feel like I'm hearing is, it's, I don't want to say part of the cycle, but with equities, especially, the thing when we were talking before the episode was that 10-year time frame, right? And I notice a lot of investors now, maybe younger investors especially, that want to see immediate gains.
Yeah.
And don't want to necessarily think in terms of 10 years, 20 years, 30 years, right? They're like, no, I don't want to know what I should be expecting in 10 years. I want to see continuous growth year after year. And so when, we know when we are, as, financial professionals, are trying to explain that longevity piece, you're like, yeah, we're going to target 8-9% of growth, but it's going to be over a long period of time, right?
Right.
That's a different, just a different viewpoint. I think that not, I wonder if you feel the same way from your perspective, just if that's shifting now, that people are tired of experiencing the black swan events, as they're called, like a black swan event, meaning like COVID, for example.
Yeah.
We had everything tumbled, so far, like 20, 30, 40%, like really quickly, because of the uncertainty in the market. Think back to September 11th, right? Like, just black swan event, right? We didn't expect that to happen. And the markets took a huge nosedive, right, at that same time. And I know, so I'm 39. I was graduating high school when September 11th happened, and my generation has lived through a lot of these unprecedented, well, quote unquote, I'm doing air quotes, unprecedented events. And so people in their, 30s, 40s, sometimes even 50s are like, I'm tired of unprecedented events and seeing the effects that they constantly have on my portfolio, because they do, right? It's like that. So I think that's part
Yeah,
of
they
the
could be
impetus,
devastating.
right? That's the impetus for that question, is like, okay, they just keep happening. How do we manage to actually grow our investment portfolios if these, black swan unprecedented events keep happening where equities sell off so heavily?
So I'm going to answer you with two different answers.
Okay.
How's that?
I like it.
One is Crandall Pierce is a company that creates charts based on financial markets, history, um, historical events, different economic indicators. And one of the charts they have is from the beginning of the 1900s through 2000 up until now, September of 2023. And they can go and they have different reasons why someone should never invest in equities almost every year. And they're usually pretty big reasons. Vietnam War, Korea War, World War One, World War Two, September 11th, all of these different things. Catastrophes have happened. And yes, history doesn't repeat itself, but sometimes it rhymes. And there's always going to be reasons to not invest in equities. And yet, invest equities have been the place to be over the last 100 years. They've created a massive amount of wealth for thousands and thousands of families, if not more, because of the ability to track economic growth, right? It's one of the only ways you can monetize or grow with the US economy is with equities over a longer period of time. Now, that's not to say you just buy and hold. Okay. And that's one of the things at Juncture we are very much in favor of not or of taking proactive action to maybe offset or mitigate some of those large drawdowns, those large losses, like COVID, the debacle and the great financial crisis of 2007 through 2009, different things like that, where you have the potential for large drawdowns, which can impair your portfolio, particularly if you're living on it. There are lots of things you can do to help manage that downside volatility while still maintaining the ability to grow over a longer period of time with US equities or equities in general. So I would say, one, all the time there's reasons not to invest in equities. And two, there are some really great strategies you can use to help manage that downside if that really is something that's bothersome.
Mm. All right. Well, I think that covers it really well, actually. And if there are any other follow-up questions, or if you hear anything else on the news, right? Hear something that you're like, what does this mean? Let us know. Like, we want to hear about it. We want to be able to answer your questions. And we certainly have plenty of things to talk about, even if we don't get questions. But I think it's so much more valuable to actually be able to speak to the things that you're thinking about as a listener, and the questions that come up that you just want to hear the perspective, um, different perspectives, even, right? Like, I'm different from you, Brad. Right? So we've
Yes.
got a little, like, we agree on a lot of stuff, but it's certainly, the CFP side versus the CFA side, and the different perspectives that we bring to the
East
table.
Coast, West Coast.
Right? Yeah, I mean, I'm a Westerner
I
girl
know.
at heart, so
you're more of a transplant to the East Coast than
I
anything.
I know. My sunshiny ways are like, why are you here? No, it's beautiful. I love Cincinnati. But yeah, so if you do have questions and anything else you want to hear us talk about, or things that are happening in the world that you just have, want to know the economic implications for you potentially, like, I don't know, we want to talk about it. So thanks for being here, Brad. I appreciate you as always.
Thank you. Appreciate the invite.
Yep. And we will talk to you again next week. Bye,
Sounds
everyone.
good. Bye.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.